And here are the three things that you need to know today. The action yesterday in reaction to some comments from Jay Powell, of course, the Federal Reserve Chair. He spoke at the National Association for Business Economics in Washington, D.C., and basically indicated that the Federal Reserve is prepared to raise rates by a half point at future meetings if necessary in order to combat inflation. He also sort of issued a bit of a mea culpa, I think it's fair to say. Listen to what he said.
The expectation going into this year was that we would basically see inflation peaking in the first quarter, then maybe leveling out, and then see a lot of progress in the second half. That story has already fallen apart to the extent it continues to fall apart. My colleagues and I may well reach the conclusion that we'll need to move more quickly, and if so, we'll do so.
So basically, again, sort of saying we weren't prepared for this pace of inflation to continue. There you see what's called the yield curve, or the spread between yields on 2-year and 10-year treasuries. It has been narrowing here, and some folks are warning about inversion, which traditionally has signaled a recession. The Fed chair seeming to indicate maybe we should be looking at the shorter end of the curve there as a better measure. But we saw a big move upward in bond yields yesterday. That move, by the way, is continuing here this morning. So again, Brian Sazzi, people are adjusting their models in order to account for potentially higher rates by the end of the year.
Yeah, I'm sure a lot of long nights for folks on Wall Street, Julie, in light of this really clear shift in tone to more hawkish from Jerome Powell. Have to lock in on Goldman Sachs' Jan Hatzius. He is now forecasting a 50 basis point rate hikes at both the March and June meetings. He sees the ultimate, the terminal rate for Fed funds being in that range of 3% to 3.25%. Also, you can see the Fed fund futures expectations. They shot up pretty notably after Powell was speaking. So, of course, those are elevated as Wall Street adjusts its expectations, adjusts its thinking around future pace of rate hikes. And it is just so interesting, Julie, how the markets always parse these words from the Federal Reserve. It always happens. But look, the street is really looking in here at this word by Jerome Powell expeditiously. That's what he said yesterday as it pertains to potential future rate hikes. Back when the committee met, that word was steadily. So it's just amazing how one word can really uproot markets and really a lot of thinking on Wall Street.
Yeah, I mean, I think now the debate becomes not just by how much is the Fed going to raise rates and at which meetings, but you and I have been talking about this a lot with guests. Can the Fed engineer a soft landing? And again, that goes back to yield curve inversion. That goes back to the question of whether we are going to enter a recession or not. So the Fed chair talked about that a little bit yesterday, too, and seems very cognizant of the challenge that is involved.